In today's video, I am going to be talking about the best dividend stock for you. Now, this is not about one singular stock, but this is about basically a video on how you can choose the dividend stock that's right for you. So we're going to be comparing two different styles of higher dividend stocks. So let's say there is stock number 1 and of course stock number 2. And let's say for example, they're both the exact same amount per share of about $40. Now this is just all hypothetical, but real world scenarios. Now let's say both stocks are $40. Stock number 1 has an 8% dividend. However, stock number 2 has a 4.5% dividend. Which one would you rather prefer? Now let's say, to play devil's advocate, that both stocks have the same track record of always paying a dividend, never lowering a dividend for over 20 to 30 years. Now let's look at these and say, well, which one is better if neither one lowers their dividend? However, one does raise the dividend, but the other one doesn't. So for example, let's say stock number 1 has paid an 8% dividend for the past, let's say, 20 years. And the reason why they are still paying an 8% dividend is because their stock price never moves. It goes sideways, maybe goes up $1, maybe goes down $2, but generally stays the same. For example, the reason why I usually don't invest in REIT stocks is because a lot of the time, or at least not in all of them, but there's a few here and there that were bigger names that I originally just never looked at because their stock doesn't move. This also goes the same for ETFs as well, but mostly for ETFs, or at least more for ETFs than it is for stocks. But let's say it doesn't move at all, but pays a massive 8% dividend, and it's been paying it for about 20 years. Meanwhile, let's say stock number 2 goes up about 5% a year and pays that 4.5% dividend, and the dividend gets raised, let's say modestly, at about 2% a year. Now, Canadian banks generally raise their dividend between 3 and 8% a year, depending on the year. So let's just say it's a bit less than a Canadian bank, because Canadian banks usually go up by about 6% and raise their dividends by between 3.6 or 3 and 8%. Now, you may be looking at this saying, well, stock number 1 still seems really interesting because I'm not going to be risking my money. It's not moving as much. It's not as volatile. And also, it pays a pretty standard dividend. I don't have to worry. I can chuck my money into it and just let it make me money. Now, that could be a good strategy. Some people make tons of money doing that. However, my strategy is a bit different. I don't always go for those massive 8% stocks and those 8% ETFs. They're nice, but a lot of the time, if you don't look back into their history, most of them will have a declining stock price or a stock price that just generally stays the same for a very long time. Now, if we look at these 10 years down the road, and we were to say, as an example, 10 years down the road, a $40 stock that essentially goes up by, let's say, 5% per year, that $40 stock will be worth about $62.05. And let's say we play devil's advocate, and let's say stock number 1, like I was saying, it generally trades sideways. Let's say it goes up a modest, let's say 0.01, or let's say 0.5%. Say 0.5% a year, which means that in 10 years, it's worth around $42. Well, with that 8% dividend, let's say we reinvested that 8%, and we, of course, kept that 0.5% as well. So let's say at 8.5% a year, Instead of that 42, the actual value is around $83.35. That is the actual value with dividends during that time. Well, let's say, for example, we have stock number 2. Well, with stock number 2, we have that 5% increase plus the 2% increase on that dividend. Now, this is when math starts to get a little bit complicated. So what we're going to do is we are not going to count at first that extra 2%, and we're just going to calculate that 5 with that 4.5, which equals about 9.5%. Well, in 10 years, instead of it being actually technically worth 62, it's actually worth around $90.53, which is about, I'm going to roughly round off to be about $7.20 better than stock number 1 per share. And that's not including the fact that we did not add in that 2% increase to the dividend. Well, what happens if we did add in that 2% dividend? Well, that 4.5% dividend would then in 10 years equal 5.38%. So you're still not getting that full 8% in that roughly 10-year period. However, with that 5.38%, if you also calculate that 5% massive gain over time, you're actually coming out ahead. So what it really comes down to is this. If you're investing for the short term and you're just looking for reoccurring revenue, that 8% may work out better for you. However, if you're a bit younger and you're looking for stock appreciation and you're still looking for a dividend income, because let's face it, 4.5% is still really good, then at that point, you may want to invest in the stock that goes up in value and, of course, the dividends that go up in value as well. However, what you want to do here is essentially, I would say, do the math over a 20-year period. And from there, you can do this math yourself. It's really not that hard. But you would be able to calculate, okay, well, let's say stock 1 versus stock 2. Let's say I want to invest for 20 years. Let's say I'm 40. Let's say I'm 40. I'm not 40 myself, but let's say I'm 40 and I want to retire when I'm 60. And which one stock appreciates the most? Which stock's dividend go up the most? And then look at it that way. Because if you're looking at it that way, you may want to go with stock number 2 if you're looking for a higher future dividend and higher stock appreciation versus, let's say, you're 60, retiring in only maybe 4 years or 5 years. And then you may want to take that 8% over that other stock that's 4.5%. However, personally, what I would recommend is to do both of them and to kind of favor one over the other. So let's say 20% in stock 2 and 80% in stock 1. That way you can still grow your money, the underlying asset, and still get those dividends. Keep in mind that dividend income is taxed less than capital gains on stocks, especially here in Canada. So keep that in mind. I hope that you've enjoyed today's video. If you have, hit that like button and subscribe, and I'll see you guys again next time.